Welcome to Learning Corner. Please don't forget to subscribe, share, and comment. This time we delve into personal finance. Digital nomads. Have you ever wondered how digital nomads manage their tax obligations while hopping from country to country? It certainly is a complex landscape. Digital nomads who earn income in various currencies and from different sources across the globe face unique tax challenges. Picture earning in euros while living in Thailand, or working for a US company while residing in Bali. The diversity of income sources and currencies can make tax filing a daunting task. Not to mention the concept of tax residency, which refers to the country where you're considered a resident for tax purposes. This can significantly impact your tax obligations, but it's not always as straightforward as one might think. And then there's the dreaded double taxation, where the same income is taxed in two countries. Sounds like a nightmare, it? In today's video, we're going to demystify the tax obligations for digital nomads. First things first, you need to understand what tax residency is. So what is tax residency? In simple terms, it's the legal concept that determines in which country or countries you're obligated to pay tax. Think of it as your fiscal address, a sort of home base for your tax obligations. Now, how does a country determine who is a tax resident? Here's where things get interesting. Different countries have different criteria. Some countries consider you a tax resident if you spend a certain number of days in the country during a year. Others base it on your center of vital interests, which takes into account factors like where your family lives, where you work, or where you have a permanent home. For example, if you're a digital nomad living in a country for more than half the year, that country might consider you a tax resident, even if you're a citizen of another country. On the flip side, your home country might also consider you a tax resident if you maintain a home there, even if you're traveling the world. But wait, there's more. Some countries have a concept called domicile. This refers to the country that you consider your permanent home, irrespective of where you might be living at the moment. In such cases, even if you're sipping margaritas on a beach in Bali, if your domicile is back in your home country, you may still be considered a tax resident there. And here's the kicker. Each country has its own tax laws and rates, and they can vary dramatically. This is why understanding local tax laws is so crucial. It's not just about knowing where you owe tax, but also how much and on what income. Remember, ignorance is not bliss when it comes to taxes. The more you understand about tax residency, the better you can plan your finances and avoid any unpleasant surprises down the line. Now that we are familiar with the concept of tax residency, how can we use this knowledge to our advantage? Well, stick around, because in the next scene, we'll delve into some useful tax tips for digital nomads. Scene script. Here are some practical tips to help you manage your taxes as a digital nomad. First and foremost, it's crucial to keep accurate records of your income and expenses. This isn't just about knowing how much you've earned or spent, but also about having the necessary documentation when tax time rolls around. Keep a detailed log of your income sources and save all receipts related to your business expenses. These could include things like accommodation, transportation, and even meals if they are business-related. This will not only help you keep track of your finances, but will also be invaluable when you're filing your tax returns. Next up, consider claiming deductions for business expenses. As a digital nomad, you may be incurring costs that you wouldn't have in a traditional job. These could range from co-working space memberships to purchasing new equipment for your work. The good news is many of these expenses could be tax deductible. However, the rules can vary greatly depending on your tax residency, so it's key to understand what you can and can't claim. Another important tip is to stay updated on tax laws. This might not sound like the most exciting task, but it's crucial to ensure you're not paying more taxes than necessary, or worse, underpaying and risking penalties. The tax laws can change frequently and vary from country to country, so it's important to keep an eye on any changes that could impact you. Finally, don't shy away from seeking advice from a tax professional. Navigating the world of taxes can be complex, especially when you're living and working in different countries. A tax expert can provide guidance tailored to your specific situation, helping you to maximize your deductions, stay in compliance with tax laws, and ultimately, save money. Remember, managing your taxes effectively is not just about compliance, it's about optimizing your financial situation. Taxes can be a significant expense for digital nomads, so it's worth taking the time to understand them and find ways to reduce your tax burden. But what if you could avoid double taxation? Let's explore this possibility. Double taxation can be a real headache for digital nomads, but there are ways to avoid it. Imagine being taxed twice on the same income. It's like being bitten by a mosquito and then being stung by a bee on the same spot. Not only does it hurt, but it also leaves you scratching your head and asking, why me? That's what double taxation feels like. In the complex world of international taxation, double taxation is a real challenge. But don't worry, there's hope. Enter double taxation agreements, or DTAs. DTAs are agreements between two countries designed to protect against the risk of double taxation where the same income is taxable in two countries. Quite simply, they ensure you don't get bitten and stung at the same time. Now you're probably wondering, how do I know if a country has a DTA with my home country? Well, it's not as hard as you might think. Most countries have an online database where you can check if they have a DTA with your home country. You can also usually find this information on the website of your home country's tax authority. But here's the catch, just because two countries have a DTA doesn't mean you automatically avoid double taxation. You need to understand the specifics of the agreement. These agreements can be as unique as fingerprints, and the rules can vary greatly. For example, some agreements might exempt certain types of income from double taxation, while others might only provide a credit for the tax paid in the other country. Understanding these nuances is crucial in avoiding the dreaded double dip. Remember, tax laws and treaties are notoriously complex and can change without warning. So it's always a good idea to consult with a tax advisor who is familiar with the tax laws of both your home country and the country you're working in. With careful planning and the right knowledge, you can avoid the pitfalls of double taxation. And that, my friends, is a win in the game of international taxation. Navigating tax laws can be tricky, especially when you're dealing with multiple jurisdictions. It's like trying to find your way through a dense forest with a compass that points in several directions at once. But don't worry, there's a guide who can help you navigate this complex terrain, a professional tax advisor. Now, you might be thinking, why do I need a tax advisor? Can't I just figure it out myself? Well, let's put it this way. Would you perform surgery on yourself? Probably not. Just as you'd want a skilled surgeon in the operating room, you should want a skilled tax advisor when dealing with your finances. One of the main benefits of seeking professional tax advice is that it gives you peace of mind. Tax advisors are trained to understand the intricacies of tax laws so they can help ensure you're in compliance and avoid any potentially costly mistakes. More importantly, a good tax advisor doesn't just fill out forms and crunch numbers. They're strategic thinkers who can help you plan for the future. Whether you're thinking about starting a business, buying property, or planning for retirement, a tax advisor can guide you through the tax implications of these decisions. But here's the key. You need to find a tax advisor who is familiar with the tax laws of the countries where you earn income. This is especially important for digital nomads who may have income coming in from multiple sources around the world. Think of your tax advisor as your personal tax diplomat. They can help negotiate the intricate web of international tax treaties, find ways to minimize your tax liability, and keep you out of trouble with tax authorities. So how do you find the right tax advisor? Start by asking for recommendations from other digital nomads or expats. Look for someone who is certified, experienced, and has a proven track record of dealing with international tax issues. Remember, a little expert advice can go a long way in saving you time, stress, and money. So don't go it alone. Get the right professional help and make your tax journey a lot smoother. Let's wrap up with some key takeaways from today's video. First and foremost, understanding your tax residency is pivotal. Knowing the tax laws of your home country and your host country is a game changer. Keep in mind, each country has its own set of rules and regulations, so staying informed is your best defense. Next, remember the importance of keeping accurate records. This will not only save you headaches and stress at tax time, but it could also save you money. Don't underestimate the power of a well-kept spreadsheet. A third key point is the avoidance of double taxation. Look into tax treaties and foreign tax credits to ensure you're not paying more than you should. Lastly, never underestimate the value of professional tax advice. Tax laws can be tricky, and a seasoned professional can help you navigate them smoothly. With these tips in hand, managing your taxes as a digital nomad can be less daunting. Always remember, tax doesn't have to be taxing.